Howdy everybody, welcome back to Intermediate Accounting, where we've been doing a deep dive on the balance sheet. We just jumped right in. We've had a few videos already on the balance sheet, and we're going to wrap up today talking about classifying items on the balance sheet and let you know where everything goes and in what order. So where have we been so far? We've talked about the elements that we recognize on the balance sheet and gave you a few definitions for those elements on the balance sheet: assets, liabilities, and equity, according to how GAAP defines them. In our second video, we talked all about how we measure and report those items on the balance sheet. So we're going to wrap up talking about classifying. Things on the balance sheet go in a certain order. In U.S. GAAP, we don't see liabilities reported at the beginning, and then equity in the middle, and then assets at the bottom. We have a certain rhyme or reason for where we put things and classify them. So that's what we need to get into right now. Where do things go on the balance sheet? Now, first example here for assets, I've got the breakdown, how things are classified in a U.S. company that follows GAAP. We'll look at later on in class maybe international financial reporting standards and how they propose that you classify and order things on the balance sheet. So our examples right here are going to be U.S. companies. Keep that in mind. But the breakdown in a U.S. company for GAAP purposes, we always begin with current assets. Some examples of current assets: cash, short-term investments, receivables, inventory, and then other current assets. And we want to list them in order of liquidity. This ordering right here is how it would be ordered in real life on a balance sheet, because that is the order of liquidity. Liquidity is a measure of how quickly we can turn something into a dollar without having any loss of value or any real struggle time commitment wise in doing that. So cash is already cash. It's already a dollar. It's as liquid as it gets. All right. So we're going to put cash and cash equivalents at the very top under current assets. It's always going to be the first one. Short-term investments would be next: receivables, inventories, and then other current assets. So again, when we're talking about current assets, we're putting them in order of liquidity. Our next category would be long-term investments, maybe investments in securities, in affiliated companies, a sinking fund where we put aside money to pay off a bond or for some other purpose that we're planning and reserve that money to earmark to do something. Or property held for an investment, like maybe we have land that we bought as a speculative investment. We're not using it in a productive capacity, just kind of holding it, hoping the price goes up. Our next classification would be property, plant, and equipment. We know all about fixed assets or property, plant, and equipment. Land, leasehold improvements, construction in progress would also fall into that category. We saw on Disney how that also includes maybe things like film cost, television cost. Next category would be intangible assets. These are assets that don't have a physical presence. We can't touch them. They still hold value. Goodwill, patent, copyrights, franchise rights would all be examples of that. And we'll have an entire chapter where we study those intangible assets. And then finally, we have just kind of a dumping ground catch-all category of other assets. These are assets that didn't really fit into our other classifications. There may be things like deferred tax assets, where we have a benefit tax-wise that it's due to us from the government. Maybe discontinued component assets. We've discontinued a segment. We haven't sold off the assets yet, but we're not using them. We're just they're just sitting there. So we need to take them out of the other parts of our classification and move them. And that's kind of the idea. Every U.S. company will follow a pretty similar breakdown on the asset side of the balance sheet. And I'm just going to show you. I'm not lying. I'm telling you the truth here. Even though I'm wearing a shirt with a beaver on it, might seem a little sus. I'm telling you the truth. Current assets. You can see right here on Disney. Cash, receivables, inventory, the current part of television cost and advances, and then other current assets. Okay, so this is the part of television costs that you're using up within the current year. Maybe licenses that expire within the year. You can see those are current. And again, in the order of liquidity: cash, receivables, inventories. Okay? So again, current assets, I didn't say it before, but it's worth pointing out. Our current assets, according to GAAP, are assets that we are expecting to consume within a year or get the benefits of within a year. or within an operating cycle. Some companies have operating cycles that are longer than a year, maybe construction companies that do great big projects, but for the most part, we're talking about 1 year. We're expecting to either consume the asset or otherwise get the benefits of it within the year. Everything else is long-term. And so we got the film and television cost right there. There'll be long-term investments that we've made. There's our property, plant, and equipment. And there's the intangible assets, and there's the other assets. So again, I told you the truth, right? It follows lockstep with the layout that I showed you. You say, well, okay, Martin, you got lucky on that one, but maybe that was a fluke. I bet you can't show me another balance sheet. Oh, I can. Here's Walmart. And I didn't cherry pick these, gang. This is just a layout that we follow under GAAP. Current assets at the top. And then again, in order of liquidity, cash, receivables, inventories, prepaids, and other current assets. Total current. Walmart doesn't report any long-term investments right there, but they do have property and equipment. Operating leases and finance leases are kind of considered part of property, plant, and equipment. I'll get into another chapter on that in the second term. And there's our intangible assets for Goodwill and then other long-term assets. So, you still don't believe me? Then fine. Pause the video and then go find your own balance sheet. All right? Take a minute, get on SEC.gov or maybe type the name of the company and annual report and find your own balance sheet and see, does it follow a similar layout as to what I just showed you on the asset side with my examples? Are there any accounts listed on that balance sheet under assets that you don't recognize? So I encourage you, pause the video, take a break, go get a drink, come back, grab your internet machine, fire up Google, and find a balance sheet and see, does it match what I showed you? It probably does. I'm not going to bet money on it because I don't have any money to lose, but I'll bet you it follows my example pretty closely. What about liabilities? Liabilities is kind of more simple as far as a classification goes because there's simply not as many different liabilities going on most of the time as we have from an asset standpoint. We have current, again, items that we expect to be paid off within a year, payables, accrued expenses, unearned revenue that we expect to earn within a year, and short-term debt. Maybe it's long-term debt, but we have payments to make within the next year. The payments we have to make within the next year falls under current. Then we have the long-term liabilities, things we're not going to pay off until more than a year down the road. Long-term accruals, long-term borrowing, and then catch-all other long-term liabilities. How about at Disney? Do you follow that? Yeah. Disney has their current liabilities, items that are going to be paid off within a year, accounts payable, current portion of long-term debt, deferred revenue or unearned revenue. Then they've got their long-term borrowings, deferred income taxes that are going to get paid more than a year down the road, and then other long-term liabilities. We're splitting it between current and long-term. And GAAP prescribes it that way. That's the way GAAP wants us to lay it out because they want a person to be able to pick up that balance sheet and very easily look at current assets and current liabilities. Current assets, things we expect to enjoy the benefit of within a year. Current liabilities, things we've got to pay off within a year. I can look at a balance sheet immediately and say, oh my goodness, Disney has enough current assets to cover those current liabilities. If they don't, that could be a red flag. And they want people to be able to see that quickly. That's why GAAP prescribes that current asset and current liability breakout right off the bat. We got equity, our final category, broken up into two components, contributed capital and earned capital. Contributed capital is all those transactions with the shareholders, common stock, preferred stock, additional paid-in capital, and treasury stock. So if it deals with the stock of the company, that's contributed capital. Earned capital, retained earnings, right? The cumulative profits that we've earned and held in the business. There's also a second little categorization there called accumulated other comprehensive income that captures a lot of those paper gains that we have. We'll talk about that later on as well. Not too important right now, though. So there's our equity part for Disney. And there's my contributed capital. And there's my earned capital. What a marathon. I hope you got something out of that deep dive of the balance sheet. I hope that it puts you in a little bit better position to do your homework in your Chapter 3 problem set, or Chapter 4, I should say. But 3 videos. What are the elements of the balance sheet? How do we measure them? And then finally, we wrapped up with how to classify them. What's the takeaway? Martin, what are you getting at here? My takeaway is you, whoever might be looking at the video, that you will be able to read and also be able to create a properly classified balance sheet with the proper measurement techniques in place. So hopefully we got you to that point. If you have any questions as you're working through your homework, I'd be happy to help. Feel free to reach out to me. Otherwise, we'll see you back here next time for a video on the Statement of Shareholders' Equity. Take care, everybody.